Wondering what is a cost segregation? Wondering if one will save you lots of money? Wondering, well, if one, frankly, will make you rich. Hey there, my name is Kenner French with vastsolutionsgroup.com. We do tax, finance, and artificial intelligence for entrepreneurs. A cost segregation breaks your real property into its component parts, some of which you can depreciate at a much faster rate than is the typical 27.5 years for a residential rental or 39 years for a non-residential real estate. The result is you could save potentially a lot of money as it relates to taxes. When you buy real property, you typically break it into two assets for depreciation purposes: land, which is non-depreciable, obviously, and a building, residential for 27.5 and non-residential for 39. With a cost segregation study, or cost seg, you may make your property much more than the building and land. Here's what's possible with a cost segregation study. Land, which is non-depreciable, 5-year, 7-year, 15-year for the remainder, and also 27.5-year for the property and 39 years for the property depending on the building's use. With a cost segregation study, you upfront load your depreciation deductions and take them sooner, but you'll take the same total depreciation over the lifetime of your property. The Tax Reform Act that occurred boosted depreciation from 50% to 100%, and this new law also allows bonus depreciation on qualifying used property. Cost segs they're made to take advantage of these new tax laws for the most part. And you can apply cost segs to rentals and offices, and even ones you've had for 10 years or one that you're buying tomorrow. It doesn't really matter. But if the passive activity loss rules affect your ability to take immediate rental losses, we need to run the numbers to see really if you can benefit. Also identify what you could do to benefit potentially even more. Tax reform is one of those not beneficial to you new laws sections that took away your ability to do like-kind exchanges for non-real property. Therefore, if you do a cost seg and then later use a like-kind exchange on that property, you'll have a taxable gain attributable to everything that's not land or 27.5 years or 39 year as a property. We recently saw a cost study on a new $400,000 property purchased actually this year. The study enabled a speed up of $50,000 of deduction to this year's tax return. For this taxpayer who was in a combined federal, state, and federal tax bracket of 40%, this put real money in his pocket, around $20,000 roughly. The cost segs are complex. In some cases, they're truly too expensive. In some cases, they really can net you a lot of money. It really depends on the circumstance. As in hundreds of thousands of dollars, it could save you maybe. As I'll just say, with everything, it depends. Check our website for details, www.vastsolutionsgroup.com, or give us a call. Again, Kenner French at vastsolutionsgroup.com, saying thank you for watching. Really appreciate it.